Welcome to the Tesla Economist. Please hit the thumbs up and don't forget to subscribe. For quite some time, I've been hearing about people waiting for the dip, particularly when we're in the 800s. A lot of people were trying to time Tesla and did sell in the 7 to 800s. It was risky, but on the other hand, the stock price was high, most likely due to the S&P effect. No one ever went broke taking profits. And now, those of you who did sell in that range are lucky enough to have Tesla's stock price back below 600. Well done, you did well. It's not my strategy. I think I would literally feel naked if I didn't have a considerable position in Tesla. But I'm not going to tell you what investment strategy works best for you. I just like to talk about what works for me, and I back it up with reasoning, numbers, and statistics. Whereas those of you who did time the market can back it up with great returns. To each their own. Anyway, for those of you who sold, it worked out well, and now you need to time your way back in. And for those of you who are still trying to build your Tesla position and were waiting for a dip, well done to hold out this long, and not get too greedy when we were in the 600s. I myself couldn't hold out that long and ended up purchasing at 620 and 600. But now we're entering the dip, it's also not quite so easy to hold the same conviction as when the news was positive and the stock price was going up. That's because there are reasons the stock is down. We've seen Tesla bombarded in the media with negative press. It affects investors, and then when they see the stock price reduce even further, it creates more fear, and some investors can't handle it and sell. But this is what a dip feels like. Warren Buffett has lots of quotes for these times, such as "be greedy when others are fearful." But the question is, how low will it really go? No one likes to buy the dip, only to see it keep dipping. In all honesty, with everything that's been happening lately, I'm surprised the stock actually hasn't dipped even further. There seems to be real support around the high 500s, and it hasn't dipped much further below that level all year. However, last time it dropped below 600 in March, it had a V-shaped recovery. This time it's hanging around, but I believe this will be due to the current negative narrative that we just need to get past. It burns out eventually, they run out of news, people forget, and sometimes Elon doesn't tweet anything too crazy for a while, and then the stock price recovers. But yeah, it is possible it could drop again. On the other hand, just do the math and see how it works for you. Say if you have 100 more shares you want to purchase, and at the time of this video we're at a $570 stock price, and you're hoping it will go to $550, then it would currently cost $57,000 to purchase those shares, compared to waiting to get them for $55,000. Okay, that's a $2,000 difference, but what if it never goes to $550? Does that mean you may end up having to pay over $600 for them if it recovers? Or perhaps there's a chance you totally miss out altogether and miss the potential to ride to $5,000 a share. Sometimes a good enough price is good enough. It's still a lot better than over $800. But you might be of a different mindset and want to really make sure you get a bargain and waiting for the stock price to get into the 400s or possibly even lower. I mean, that's probably and hopefully unlikely. So if that is your target, just think to yourself how frustrating it might be to miss out on the stock price ride when it goes to the moon or Mars. Although perhaps you follow a dozen or so stocks like this and continually wait for one of them to go on sale, again, there are plenty of different investment strategies out there. But for those of you who want to be all in on Tesla, then it would be a shame to miss out. But there are other strategies that you could use, such as dollar cost averaging. With the stock price being down where it is now, and if you're waiting for it to get a bit lower, then perhaps you could put 1/3 or a half of your assigned investment fund into the market now. Then if it did recover, at least you wouldn't have totally missed out. And if it does dip again, then you can keep buying on the way down. As the thing is, trading like this, when you're trying to time the market, you're dealing with herd mentality, which can be entirely irrational. I've been here before, when I was buying my initial stake in Tesla. I did it at various stages. I had a portfolio I wanted to build, and had funds earmarked for other companies and IPOs coming up. But the more I studied Tesla, the more of it became earmarked just for Tesla. In fact, in the end, the only other position I ended up buying was NIO, but I dumped that a long time ago and bought more Tesla. But when I was buying up this position, I just bit the bullet and did it. I didn't try and risk it going down any further. To me, there being a chance of missing out of Tesla was a much bigger risk than me overpaying for the stock. That's just me though, and it turned out it wasn't the right decision anyway, as the stock went literally 40% less at one stage. In other words, I could have bought nearly twice as many shares for the same amount of money. And what about me now? Am I about to buy the dip too? Well, to be honest, it's going to take quite a purchase these days for me to have any impact on my Tesla holding. Including the leaps I have, I'm satisfied enough with my position in Tesla and not looking to build it any further. But I have all this experience and knowledge on the company too. I have been here so many times before. And what I used to do in these times was play options. Although aside from leaps, I haven't been doing many lately, not since the S&P inclusion actually. It's not that I'm trying to time the market or necessarily waiting or hoping the price drops much lower, but if it does dip below 550, then I think the odds are good enough on my side to speculate with some call options. The current option I'm looking at is July the 2nd, with a strike price of around $620. The price is currently about $30, implying that I would need the stop price to return to above $650 to make a profit, and if it reaches $700, then that's nearly 3 times my money. That's the current price though. Like I said, I would only consider it if it drops slightly further, and then I might be able to get a $600 strike price for $30. And I chose July because we'll have deliveries and earnings reports by then too, which should hopefully give the stock price a bit of a boost. But this is just for a bit of fun. This is not any type of investment strategy. It's more like someone who is going to the casino who thinks they have a system, and I can afford to lose the money if necessary. In other words, I'm not suggesting anyone else do this. I'm merely talking about it for entertainment purposes. However, when it dips too far, it will possibly bounce back quickly, and I would hope get into the mid-600s again. If it did that quickly, I would dump the options and take the profit, rather than wait out the expiry date, as there would still be the several months premium left. Okay, thanks for listening, please hit the thumbs up and don't forget to subscribe.